What's up? This is Ryan with Planet Cheapskate, and I'm actually recording this from my house because we had a blizzard outside um, this morning, and so I just didn't get to the office. But before we get into this, I'm going to be covering mortgage insurance, and I just wanted to invite you to subscribe and join our community. My dream is to build a community where we can all help each other out through this very stressful time. Going through the home loan process. I'm going to be making a video today on mortgage insurance. There's multiple types of mortgage insurance, and I'm going to be kind of going through all the different types of mortgage insurance. So what is mortgage insurance? Mortgage insurance is just an extra insurance policy that the lender is going to make you take out if you don't put 20% down. Or in the case of an FHA, they require it regardless how much you put down, they're going to require that you have mortgage insurance. There's a few little tweaks with it, and I'll get into those, but I'll start out with just FHA mortgage insurance. The thing with FHA mortgage insurance is that it's going to be based on a percent of your loan amount, and it's based on 1.75% of your loan amount at origination. So no matter what size of loan you get, no matter what your credit score is, no matter what anything is, your FHA mortgage insurance is going to be 1.75% of your loan amount. Now, that's not your purchase price. Your purchase price is different than your loan amount. FHA, you're going to be required to put 3.5% down. So they take that 3.5% off, and then that remainder is your loan amount, and that is what the 1.75 is based upon. Okay, so year two, let's go ahead and talk about year two. Okay, so you are going to pay that FHA mortgage insurance up front, that 1.75. The cool thing about FHA and USDA, you can actually finance it into your loan, which I would say probably 99% of people do. So what that does is it just increases your loan amount a little bit, but you're able to finance it, so it's not as bad. It's not like it's going to increase your closing cost to a ridiculous level. So year two, let's talk about year two. Year two, there's a crazy matrix depending on how much you're borrowing, how much you put down, all that. The thing to understand about year two is that most of you are going to fall under 0.55%. And so I need to explain a little bit about what are called BIPs, okay? And the easiest way to understand what a BIP is it's just a percent of a percent. So when I say 0.55, I'm basically saying 55% of 1%, okay? So 0.55% is 55% of 1%. That's what a BIP is. The easiest, there's a more complicated definition and understanding of it that we use in the financial world, but for ease of understanding, just understand a BIP is a percent of a percent. So when a percent is too small, when it's less than 1%, we refer to something, and so 0.55 would be 55 BIPs. Okay, so that is, hope that makes sense to you. So 0.55 is what you will be paying, most of you. Now, you could pay less or more based on how much you put down, what your loan size is, how much risk you take. It all has to do with your risk, okay? So moving on to USDA loans. USDA loans, they're weird, but we'll get into them because they are beneficial sometimes. But on a USDA loan, it's not necessarily called mortgage insurance. It's just called a guaranteed fee that you pay, and it's 1% regardless of the loan size. And so what you do is that 1% you pay, but you can also finance it, much like the FHA. You can finance this 1%, so you don't have to put it to your closing cost. After that, it's going to be 0.35, okay? So 0.35 every year. So we're talking what is it? Yeah, 0.35 every year. Okay. Now, moving on to conventional. Conventional is probably the most complicated and the one that varies the most, because on a conventional loan, anytime you put less than 20%, you're going to pay mortgage insurance. It's private mortgage insurance. These are private companies. Before, FHA, USDA, you're paying this to a government entity that is insuring your loan. In a case of a conventional, these are private companies that the lender gets set up with, so they can vary. I mean, you can pay as little as 0.1, okay? So, which would basically be 10% of your loan amount. I'm sorry, not 10%, it would be 10% of 1% of your loan amount. So it could be that low, or it could be a full 2%, depending on the company, depending on your credit score, all kinds of different risk factors. It varies based on your details of your credit report. So that is mortgage insurance. It's a necessary evil. I don't like it. It kind of sucks. One thing to know is that depending on the lender, you can get cheaper mortgage insurance. As a broker, I actually work with a company who has the lowest mortgage insurance in the industry. And so I'm able to get people's mortgage insurance super, super low on conventional. When you got USDA, when you got FHA, it's not going to matter as much because those are pretty standard expenses. On conventional, you're going to see tighter rates as far as shopping around goes. Where you're going to see the bread and butter game changer is on mortgage insurance. In fact, there's certain situations where a lender might have a higher rate, but their payment's going to be less because their mortgage insurance is less. So it's something you have to watch. Keep your eye on how much the private mortgage insurance is if you have a conventional. And if it's too high, if it seems pretty high, you may want to shop around. Go to a broker. They'll shop around for you. One credit pull. They can shop multiple lenders to get your PMI down. So that is mortgage insurance. Hope it helps. Look forward to hearing some feedback from you. If you have any questions whatsoever, reach out to me. If you like this video, feel free to subscribe. Watch some of my other videos. I'm sure you're going to love those. Go into all the different loans, everything like that. So reach out if you need anything. Thanks for being a viewer, subscriber, everything with Planet Cheapskate. I will see you on the other side. Okay? Bye-bye.